I think most people have heard the saying that consistently outperforming the market, specifically the S&P 500, is nearly impossible. You probably heard that even professional investors struggle to beat the index over the long term, and legendary investors like Warren Buffett, Michael Burry, and Peter Lynch are often cited as rare exceptions, and that if you outperform the market consistently, it's basically because you got lucky. You'll see headlines claiming that these 5 to 10 companies are responsible for most of the gains in the market, implying that unless you'd managed to pick these on 1% of the stocks in the index, you'd have underperformed, implying that you'd have to be a psychic or the most skilled investor in order to pick the right company. So you shouldn't even try, or you should just invest in a low-cost ETF. And this is something that gets brought up like every year. What I want to do in this video is highlight why I think these headlines can be incredibly misleading, and this sort of sentiment can discourage investors from even trying to pick individual stocks. I'll dive into the actual data and unpack why I think it's not as impossible for investors to beat the market as they would lead you to believe, and not just for a single year, but over an extended time frame. Now, before I get into this, I want to clarify that I'm not against ETFs. In fact, I've held low-cost ETFs in the past. With an ETF, you're essentially getting the average return of all the companies in the fund, both the strong and the weak performers. My goal is to achieve the highest possible returns and outperform the market. I want my portfolio to compound at the fastest sustainable rate while managing risk effectively. Even a slight outperformance of the market over time can significantly boost your returns. In this example, it only takes a 2.5% increase in the annual rate of return to double your total gains over the long run. That's why I take the time to research individual stocks to find what I think are high quality companies with strong fundamentals, significant growth potential, and attractive valuations, while avoiding companies with weaker fundamentals or stocks that don't fall within my circle of competence. Starting off with the argument that gains are being driven by a handful of stocks. In this article, we can see that 7 tech stocks are driving the market. It's a catchy headline, but I think it's misleading. They go on to say that of the 500 stocks in the S&P 500, that 7 companies, the Magnificent 7, are outperforming the gains of the remaining 493 companies. Now, you might look at this and think that each of these 7 stocks have outperformed the market, and that the remaining 493 companies have all underperformed the market, but that couldn't be further from the truth. These articles will often combine poor-performing companies with strong ones to offset gains, or assess the contribution of the gains as a dollar value or on a market-weighted percentage, meaning that larger companies' returns have a larger monetary impact on the index, which I think should be obvious. For example, a 1% gain in a $1 trillion company translates to a larger dollar increase than a 100% gain in a $1 billion company. But as an investor, I'm not concerned with the absolute dollar gains. I care about the rate of return. I'd rather invest in a smaller company growing at 100% than a mega cap stock delivering just 1%. In this article's defense, they do elaborate on this, but other articles don't. So if we drill down into the numbers from this article, we can see that of the Magnificent 7, the returns of the group are being driven mainly by Nvidia, which has gone up over 400%, and Meta, which has increased around 200%. Apple and Amazon have performed in line with the index, and Tesla has actually underperformed the index during the period. So how are the other companies in the S&P 500 performing? The index grew around 35% in this period. Are there any other companies that had performed better than that? Well, FICO, Broadcom, and AMD had increased over 150%. ServiceNow, Palantir, and Palo Alto Networks had increased around or over 100%. Salesforce, Booking Holdings, and CrowdStrike had increased over 70%. Caterpillar, Oracle, and Micron had increased around 60%. Chipotle, Garmin, and MasterCard had increased around 50%. That's already around 15 companies that have either outpaced or performed similarly to the combined 65% performance of the Magnificent 7 of this period, and there are many more companies that have outpaced the market. We can see here in this graph the percentage of companies in the S&P 500 that have outperformed the index each year. In 2024, we can see that 28% of the companies in the S&P 500 outperformed the index. That's around 140 of the 500 companies in the S&P 500. That's a lot more than the 5 to 10 companies that these headlines lead you to believe are driving the gains in the market, and that's a lot of companies that you could have picked and outperformed the S&P 500. Now that's 2024. If we look back over the last 30 years, we can see that 27 to 28 is actually the lowest percentage of companies in the S&P 500 to outperform the market. What we can see is that over the last 30 years, generally 40% or more of the companies in the index have outperformed the S&P 500. That's at least 200 companies every year that you could have picked and outperformed the index for that year. That's a lot easier than 1% of the market. So there are a few companies outperforming the index on a yearly basis, but we don't want to outperform the market for just 1 year. We want to do this over an extended time frame. Included in the outperformers every year, there will be some companies that will go up a lot in that year and down a lot the next year. Some of these companies will be trading purely based on market enthusiasm or recent news announcements, which can happen without any way to predict it, or some of them will only beat the market by a marginal amount. What we want is to find companies that increase our chances of reliably and consistently beating the market by a meaningful amount over a long time frame, which is harder to do and narrows the list of companies. So how is this possible? I think Peter Lynch puts it well in an interview on how to beat the market.
So today, there's so much information everywhere, information overload. Does that make it harder for active investors? The indexers say everyone's got access to the same information at the same time. You can't beat the market.
Well, the way you beat the index is you avoid the stocks to go down. You avoid the steel companies and the oil companies and Sears and Penny and where the companies are deteriorated. I mean, companies are dynamic. Behind every stock, there's a company. These are not lottery tickets. So you're trying to find the companies within the S&P 500 that are doing better. They're going from crappy to semi-crappy to good. That might take a couple of years, or they're going to grow for a long time. And you're trying to avoid the companies that are going south. That's how you beat them. Or you find some companies outside the S&P 500 that are great companies. CarMax was not in the S&P 500. They went up 200-fold. There's a lot of companies that enter, and a lot of their great performances before they go in.
To drill into what Peter Lynch is saying, my interpretation is that you should avoid the companies that have poor or worsening fundamental performance and focus on the companies that are doing well and have strong growth and good fundamentals. Warren Buffett echoes the sentiment with his quote, "Buy great companies at reasonable prices." Looking at the returns of the S&P 500, we can see that the average returns with dividends reinvested over a 5-year period is 15% and 13% over a 10-year period. So let's look at some of the companies that have outperformed the market over a long period of time and see if there are some common traits in these companies. I'll be using my investment analysis platform to analyze the fundamentals of some of these companies. The link is in the description if you want to try it out for free and follow along. For these companies, we're going to cover the increase in price and fundamentals over a 10-year period. First, we have Google, which has returned an average of 20% per year over 10 years. They're growing their revenue, earnings, and free cash flow steadily each year. Adjusted free cash flow has grown on average around 20% each year over 10 years. Fortinet has returned an average of 32% per year. Revenue, earnings, and free cash flow are growing steadily. Adjusted free cash flow has grown on average over 20% each year. Medpace has returned an average of 28% per year. Revenue, earnings, and free cash flow are growing steadily. Adjusted free cash flow has grown on average around 20% each year. Dexcom has returned an average of 20% per year. Revenue, earnings, and free cash flow are growing steadily. Adjusted free cash flow has grown on average around 20% each year. Meta has returned an average of 24% per year. Revenue, earnings, and free cash flow are growing steadily. Adjusted free cash flow has grown on average around 32% each year. Netflix has returned an average of 30% per year. Revenue and earnings are growing steadily. Adjusted free cash flow has grown on average around 39% each year. FICO has returned an average of 35% per year. Revenue, earnings, and free cash flow are growing steadily. Adjusted free cash flow has grown on average around 20% each year. Broadcom has returned an average of 35% per year. Revenue, earnings, and free cash flow are growing steadily. Adjusted free cash flow has grown on average around 38% each year. ServiceNow has returned an average of 28% per year. Revenue, earnings, and free cash flow are growing steadily again. Adjusted free cash flow has grown on average over 30% each year. ASML has returned an average of 20% per year. Revenue, earnings, and free cash flow are growing steadily. Adjusted free cash flow has grown on average around 14% each year. So that's 10 companies already that have outperformed the market over a long term, in some cases by more than double over the last 10 years. If we look further at the companies, we can see that for the most part, they have strong fundamentals and are growing at high or steady rates. Now, there will obviously be exceptions. Some companies with strong fundamentals won't perform as well or underperform in the short term. There will be companies that have weak fundamentals that perform well. I think it's a lot harder to predict which companies these are going to be and when it will happen. Ultimately, our goal is to find a reliable approach to increase our chances of selecting stocks that perform well. As Peter Lynch says, behind every stock there is a company. If the company does well, the stock is more likely to do well. In summary, I think the idea that only a handful of stocks drive market gains is misleading. There are loads of companies that outperform the S&P 500 each year, and history shows that there are a few stocks that have been able to do so over long periods of time. By focusing on businesses with strong revenue, earnings, and free cash flow growth with solid fundamentals, I think I can significantly improve my chances of beating the market over the long run. I'd love to hear what you're investing in. Leave a comment below on what stocks you think will outperform the market. If you found this video helpful, hit that like button and subscribe for more stock investing news and insights. That's it for this video. I'll see you in the next one.